I don't think we learned much new from the minutes compared to the press conference. We know the Fed is a little more concerned about inflation, and there is some indication that perhaps the tapering timeline may be slightly accelerated versus what we were expecting a few months ago. But in the big scheme of things, I think the market is really overestimating the importance of tapering or any signal, for example, around Jackson Hole. This is one of the most debated events of the year. It's one of the most well-flagged events. The Fed has been drip-feeding information for months and months on how this process will go. And I think the bar to change the tapering timeline from December is very, very high. And as a result, even as you seeing this discussion progress, it's not really having a big impact in the market. In fact, it's having the opposite impact. Yields are going down. So I think tapering is not really as big a deal for the market as it was in 2013.
George, as we've been speaking, as we've been doing the show this morning, I've been keeping a very close eye on what's been happening with the 10-year U.S. Treasury, now down at around 1.26. So we're down another 6 basis points this morning. It's remarkable how much ground the 10-year U.S. note has covered just in the last couple of weeks. What is going on there, and why has the market given up on this inflationary narrative?
As you say, it is pretty remarkable moves. So back in November of last year, I was very optimistic on the reflationary narrative. You had this massive economic reopening going on in Q1 and Q2. But I think what is going on with the market now, it's flip-flopping between different regimes. So in Q1, it was pricing this gangbusters narrative. But I've turned over the last few months more cautious, because I think the key observation to make is that the second half of the year is going to be very different to the first half, which was the reopening. The second half is going to be all about understanding the post-COVID scarring effects. You have the end of the fiscal stimulus, which was huge. You have the new Delta variant. So the market is moving to try to understand what the new steady state is, rather than the reopening of the economy. And essentially, it's pricing a much more pessimistic steady state, which I, in general, would tend to have agreement with. I think there's all sorts of unanswered questions around, for example, how much will the consumer be spending once this initial pent-up demand is over? What's the impact of the new Delta variant? And there's good reasons to think scarring may be quite high. And what the market is doing is essentially reverting back to pricing a much more pessimistic medium-term growth picture as this initial reopening is out of the way.